5, 4, 3, 2, 1. Start. Diamonds have long been considered a symbol of luxury, elegance, and status. Their sparkle, durability, and perceived rarity have given them a unique place in global culture and commerce. Often priced higher than gold per unit weight, diamonds are seen as one of the most expensive natural materials available to the public. However, despite their high price tag and popularity in the world of fashion and celebration, diamonds are surprisingly less preferred when it comes to serious investment. This may seem contradictory at first glance, but there are several reasons why gold continues to be the preferred choice for investors across generations, while diamonds remain more of a luxury item than a financial asset. One of the primary reasons diamonds are less preferred for investment is the lack of standardization. Unlike gold, which is valued based on weight and purity, diamonds vary widely in terms of size, shape, clarity, color, and cut. This makes pricing less transparent and more subjective. The lack of a universally accepted pricing mechanism creates confusion and inconsistency. While gold has a daily benchmark rate that can be tracked globally, diamond pricing depends on multiple factors that require expert evaluation. This inconsistency makes it difficult for ordinary investors to buy and sell diamonds confidently without relying on third-party assessments. Another reason is liquidity. Gold is highly liquid and can be easily converted into cash almost anywhere in the world. Whether in the form of coins, bars, or jewelry, gold can be sold with relative ease, often within minutes. Diamonds, on the other hand, do not enjoy the same level of liquidity. Selling a diamond can take time and often involves significant value loss. A person trying to resell a diamond may not receive a price even close to what was originally paid due to dealer margins, certification costs, and resale market limitations. This lack of liquidity makes diamonds a less attractive option for those who view investment as a means of generating returns or ensuring emergency security. Additionally, diamonds are subject to higher markups and retail pricing strategies. When purchasing a diamond, much of the cost includes branding, marketing, design, and craftsmanship. These elements do not necessarily add to the resale value. In contrast, gold is priced primarily for its material content, which remains relatively stable across different markets and products. An investor buying gold pays for the weight and purity of the metal, which directly determines its market value. This makes gold more transparent and reliable as a form of wealth preservation. Another important factor is the difficulty in verifying a diamond's authenticity and value without professional help. While there are tools and certifications available, these are not always accessible or understood by average buyers. Fraud and imitation are also more common in the diamond market. Synthetic diamonds have become increasingly difficult to distinguish from natural ones without advanced testing. This further complicates the investment angle, as buyers may unknowingly purchase a product that does not hold its expected value in the market. The role of gold in global finance also plays a part in its continued preference as an investment. Gold is considered a monetary metal and is held by central financial institutions as part of their reserves. It is used in trade, economic planning, and as a hedge against inflation. Diamonds do not serve such a role. They are not accepted in trade between countries and have no backing in formal financial systems. This distinction gives gold an institutional legitimacy that diamonds lack. Investors often feel more secure putting their money into an asset that has historical and global financial relevance. Volatility is another concern when it comes to diamonds. While gold prices can fluctuate, they tend to follow global economic trends and are influenced by predictable factors like inflation, interest rates, and currency value. Diamond prices, however, can be influenced by subjective trends such as fashion, marketing campaigns, or changes in consumer demand. The value of diamonds does not always respond consistently to economic shifts, making them a less reliable store of value during uncertain times. For risk-averse investors looking for stability, this unpredictability can be a significant drawback. Furthermore, gold is divisible. It can be purchased and sold in small units, allowing people to invest based on their budget and financial goals. This flexibility is not easily available in the diamond market. One cannot buy a small fraction of a high-value diamond with the expectation of reselling it later for proportional value. Diamonds are generally traded as whole pieces, and their value is tightly linked to specific qualities that do not scale easily. This limits accessibility and restricts partial investment options. Storage and security also play a role. Both gold and diamonds require safekeeping, but the established infrastructure for storing gold is far more developed. Gold can be stored in secure vaults, safety deposit boxes, and institutional facilities with verified documentation and insurance. Diamonds, while smaller and easier to hide, require more rigorous documentation to maintain their value. Without proper certification and storage conditions, even a valuable diamond can lose credibility in the eyes of future buyers. Lastly, the emotional and symbolic value of diamonds often leads to them being purchased for personal reasons rather than financial ones. They are gifted in ceremonies and worn for beauty rather than stored for returns. This cultural significance, while adding to their allure, also limits their role as a practical investment. Most people buy diamonds to mark milestones, not to build wealth. In contrast, gold is widely accepted as a savings instrument across cultures and age groups. It is often passed down from one generation to the next as a means of financial security. In conclusion, while diamonds may carry a higher price tag than gold in many cases, they do not offer the same advantages when it comes to investment. The lack of standardization, difficulty in resale, lower liquidity, and absence of institutional recognition all contribute to their reduced role in the world of finance. Gold remains the trusted choice for those looking to preserve value, hedge against economic uncertainty, and maintain long-term security. Diamonds will always shine in the world of beauty and celebration, but in the realm of investment, they continue to take a backseat to the enduring and reliable appeal of gold. Stop.